The global economy is at a historic juncture. Overseas, the euro crisis is brewing, with Greece teetering on default and that shackle Italy and Spain being not far behind. Here in the United States, angry protesters are condemning financial inequality as the bank seems to continue receiving preferential treatment. After the mishandling of the debt ceiling crisis and with political posturing controlling the debate, the economic landscape seems rife with uncertainty. My name is David Acomazzo, adjunct professor of finance at the Graziadio School of Business and Management at Pepperdine University, managing director at Cervino Capital, and advisor to Thalassa Capital. Welcome to Stop the Madness, a recipe to jumpstart the global economy, a panel discussion for the Graziadio Business Review. Here with me today, a few colleagues: Donald Atwater, PhD, practitioner faculty of economics. Don teaches managerial economics, macroeconomics, and international business, and also owns and operates a company dedicated to building goal-driven communities. Welcome, Don.
Thank you. Pleasure to be here.
Daryl Stanley, DBA, professor of finance and accounting. Daryl is a well-known financial consultant with special emphasis on valuing corporations for a variety of purposes. He has completed global assignments as well as having served as chief appraiser of international valuations for Standard & Poor's in Europe, Central Europe, and Russia. Welcome, Daryl.
It's a pleasure to be here, indeed.
Edward Fredericks, practitioner faculty of finance and principal of Iswin Asset Management. Edward has expertise in intelligent database technologies, advanced financial asset valuation, and behavioral issues in financial decision making. Welcome, Ed.
Happy to be here, Dave. Good to see you again.
And Clemens Kavnatsky, adjunct professor of financial risk management and founder and CEO of FX Investment Strategies, a registered investment advisor. He is also the author of Market Wrap, a regular feature on the Graziadio Business Review blog. Welcome, Clemens.
Pleasure to be here. Thank you.
And last but certainly not least, Michael Shires, PhD, Associate Professor of Public Policy here at Pepperdine University. Michael's primary areas of teaching and research include state, regional, and local policy, technology and democracy, higher education policy, strategic, political, and organizational issues, and quantitative analysis. He is an active consultant to local and state governments.
Thanks for having me here today.
Well, so let's get started. So it looks like the U.S. economy is on life support, perhaps a stall speed, as PIMCO has been calling it. And at the same time, we have a problem, a fiscal problem, a debt ceiling debacle that sort of highlighted perhaps the severity of our fiscal position and maybe some of the problems with our political process. How do we balance the act of helping the economy recover, perhaps in the short term, and maybe simultaneously take our deficit down? Daryl?
Well, I think it all centers again on long-term investment. And we have to focus the ball on getting the commitment of corporations to put capital into long-term investments with profitable IRRs. And this is the underlying problem that's existing globally. OECD said that this was starting to be a major problem in the emerging markets, that likewise there's not the capital commitment to investments. So we need to come up with a fiscal policy of reintroducing investment tax credits geared towards industries that in which we're heavy importers of items, and likewise that have a multiplier effect to put individuals to work, both in the U.S. and globally.
Don, what is your take?
I guess my first sort of point on this is that I'm not sure that we have a good idea of what recovery is. Recovery means different things to different people. The context of where we are today is dramatically different than where we were in the early 2000s and in the 90s, for example. There are tremendous shifts of wealth going on between different players in the global economy, and that's inevitable to continue. We're not growing wealth here in the U.S. Other countries are. Currently, we have a baby boomer group that is going to be aging out of consumption, and our consumption engine will obviously be feeling that. We have a lot of unemployment. We have a number of people, I think, in the 99% group that's out there protesting who are unemployed. Jobs recovery is an entirely different question than perhaps wealth or consumption or growth of investment and the rest. And we have a lot of debts and liability issues that we didn't have burdening us as we try to go forward. So I guess my point is I'm not sure recovery is getting back to where we were in some past sense, but it may be sustaining ourselves and reducing what it is we see perhaps going down in the future. On the other side, deficit reduction, there was an interesting quote from Warren Buffett at CNBC. He said, deficit reduction is easy compared to recovery. And the deficit reduction solution he has was to pass a law that basically any politicians who were sitting in Congress when the government debt, I think, became 3% or more of GDP would automatically not be eligible for re-election. That's a political issue, much different than recovery.
Could we say, Ed, that maybe the problem is managing the short-term issues with the long-term issues? Maybe it's some kind of needed short-term stimulus, but then managing the long-term fiscal liabilities?
Well, if you look at interest rates and see that interest rates are 0%, what better stimulus could there be than to offer free money for investment and input into whatever project you want? So perhaps I think that the issue might be more or less just balancing the checkbook per se, that we make sure that all these entitlement programs are fully funded and we match our outflows with our inflows. So perhaps at the federal level, we had the same problem that many states are seeing, that again, they promised too much to too many people. And we relied on one-time events or gimmicks in order to boost the inflow. If you go back a couple of years, what did we have in the 80s? We had a boom in the late 80s that was funded by a boom in the stock market, tax benefits, by government spending, defense spending as Reagan boosted the economy. In the 90s, we had increased money going into the stock market as people went from more of a defined benefit to a defined contribution, right? We all went over to 401ks, which increased the flows in the stock market and created a boom. And then on top of that, we had this paradigm shift over to the internet, which fueled quite a lot of IPO activities and quite a lot of wealth creation through public offerings of this new technology. So to me, it seemed like we were just relying on a one-time event to boost the inputs, to boost revenue in order to satisfy what we owed, to satisfy entitlements or what we owed. And that's what states did during the 2000. As the real estate market boomed, states found themselves very flush with all this fee income that was coming from the housing industry. And what did they do? Did they save for a rainy day? Did they try to even out their cash flows as perhaps might be a prudent thing to do? And they didn't. Instead, they just paid it out and promised more and more. And so once those flows, once those inputs stopped, here we have these states now scrambling for revenue sources. So what are we supposed to do? Are we supposed to now accept higher taxes so that we can then adhere to all these promises that politicians made when times were good? So again, the short term versus the long term, I think we shouldn't focus on the short term. We should really focus on what makes sense, balancing the books, and ensure that what we are promising, what we do pay out, we are able to raise in a general sense in terms of a reasonable tax policy, reasonable revenue policy.
So I hear the magic word, taxes. So should taxes go up?
Well, I think taxes in some ways will go up. I mean, whether you raise taxes to balance the budget, or whether you inflate out of the situation and you tax quality of life. I mean, there's going to be some net decline in overall quality of life in people's disposable income. Mm-hmm. I think the hardest part about all this is we created some unrealistic expectations of what our economy should look like. Sure. And this goes to your point. I mean, it's 3 years ago we were imagining money that didn't exist when we sold houses, and it just fed on itself, and we created this image of a standard of living. Today we're kind of where we were 3 years ago, except that nobody has confidence in what's going forward. I think if you're worried about short-term recovery, you really have to tap into that, and that's a leadership issue. That's a political issue that says somebody's got to step forward and inspire Americans, A, that we're going to figure out how to fix this, but more importantly, that it's okay. That unrealistic version of the world we had 2 years ago was just that. And that the fundamentals of the American economy have changed because we've overreacted to that. And that what we really need to do is focus on where we're strong and how we can move ahead. If you want to worry about things like short-term stimulus, we're doing it all wrong. What we've done with our stimulus is said this is a jobs preservation program for relatively high-wage government employees and contractors.
Or a housing program,
Or
right?
for a housing program.
Yeah.
And what we really need to be saying is we want to leverage this in the economy. We want to create human capital, get this money in the hands of the private sector. And one of the biggest problems for small businesses, which is our job engine, is they can't get credit. I mean, I have a friend opening a grocery store. He's taking his savings out to open it because he can't borrow money to buy inventory.
And massive increases in regulations that have occurred over the last 3 years.
And government's got to get out of the way. I mean, the regulations on mid-sized regional banks, they can't loan money unless you made a profit the last 3 years. Well, not even our Apples of the world can always say that.
The
And so-
pendulum swings
Yeah.
both directions, doesn't
No,
it?
you bring a good point because you said interest rates at zero are quite an incentive, but all that liquidity is really just fictional. It's not really in the system. It's not cannot be
it's sitting
accessed
there.
Yeah.
by
We talk about leadership, and you can see it in corporate America's behavior pattern about the leadership at the Fed, the leadership in the Congress, the leadership in the White House. I'm just looking at Microsoft's June 2011 annual report, and I was shocked to see the tax rate that fell to 17.5%, down from 36. So I went to the 10K to check it out. What are they doing? Shifting abroad, using various tax havens, and not bringing the cash back in order to reduce the tax rate to 17.5. So we've got to get that leadership back that will commit to a short-term solution as well as long-term commitment to investment in order to move the economy forward. You brought up taxes, and you have to take a close look at the fight going on in Washington between the Obama administration's Council of Economic Advisors with Romer's article clearly stating that increases in taxes at this time would contract the economy, and she's booted out or quit. Who knows what's the story? And now we've got a new chairman of the Council of Economic Advisors that's basically for tax increasing and government solutions to the problem. So corporate America is going to do what is logical. Keep my money abroad, not invest. And I keep coming back to the importance of investment for long-term as well as short-term stimulus.
But then I would like to say, if the problem is to some extent a shrinking aggregate demand, then can we really solve that problem by just giving incentive for capital to come back, maybe to the United States, and to be invested? And if demand is shrinking, then can we really solve it that way?
I have my severe doubts. I think the problem is not a fiscal problem. It really is an incentive problem. And I want to make a little detour via the Fed, because nobody has brought the Fed up here. I think the Fed, in his latest twist operation, is playing an extremely dangerous game, because essentially they're flattening the yield curve. And when the yield curve is flat, we're not close to we're relatively close to an inverted yield curve, which is always bad. An inverted yield curve does not make economic sense. And I'm afraid that there is a danger that we run into an inverted yield curve, which is typically a precursor for a recession.
So what you're saying is that by utilizing Operation Twist, instead of actually stimulating the economy, they may be causing a recession by inverting a yield curve.
I mean, it's possible. It's just a too dangerous game that we're playing. I think the Fed has done more than enough. I think QE2 was not necessary. That's my personal opinion. I think QE1 was probably necessary to get us out of the abyss, but QE2 was not necessary. We're essentially having an economy that's on life support. And it doesn't matter how much morphine or drugs you put into the patient, you know, it takes a while for that patient to recover. We've done what we need to do. The medicine is in there. Let the economy recover itself. Now, what we need to do is some political leadership and to establish a country and a basis where people have the incentive to work hard, have the incentive to save, and have the incentive to create new businesses. These incentives aren't here anymore. You know, I think most of us immigrants came here because we thought this is the land where you can work hard and you can make it. you have the flat structure of the society where everybody has a chance to make it. You have the foundation in terms of the corporate culture where you can build a business, and if you fail, you fall down, you start up again. A lot of these incentives are gone, and that's why America's corporations are keeping cash abroad. That, you know, GE had record earnings, 16% up, but most of that came from overseas. So I don't see any incentive, and again, it's not a fiscal issue or an economic issue rather than a political issue, to build a framework where the corporations can work and do their business as free as possible with as little government intervention as possible.
You talk about incentives, and you take a look at the current interest rate for T-bills, and you recognize the negative 4+% of real interest savers are taking.
Mm-hmm.
And you wonder who's the dummy, saving or going out and spend.
Mm-hmm.
And I think you come back to when you were mentioning about leadership again. You know, it's time to refocus on the Federal Reserve. We do have 2 vacancies. We're having one expire in January of next year. Neither of those positions will be filled by a presidential appointee because they will not get through the Senate. So we're going to have 4 of the 7 Board of Governors in place. And it's probably arguably the weakest Federal Reserve we've ever had in the history of the Republic. If you take a look at the members of the Federal Reserve, their backgrounds as small-town banker, regulator of securities and insurance in Maryland, a background as running San Francisco Fed, and of course our chairman. But the problem is that we don't have a Fed that inspires confidence.
Well,
And it's got to come back. It simply has got to
Mm-hmm.
have individual. We're almost entering what I refer to as the McFadden 1934 tirade all over against the old Fed and Eugene Meyer, who was chairman of the Fed in 1930 and 1933, and defended the dollar with higher interest rates, and as alleged by many, took us into a more deeper recession.
Most definitely, yeah. That's the general theory. Yeah.
The general theory is that, but we got to remember that there was a concentrated policy of both Congress and the White House to defend the dollar on the gold standard after the United Kingdom went off the standard, and the sterling was allowed to float. And so, you know, again, it's your point, and it's well taken. Leadership at all levels, and the Fed is probably the most atrocious leadership we've ever seen in the history of the Republic.
Well, I think you can also say it a little bit more simpler in just that, as Mike pointed out, banks have liquidity, right? Banks have all the liquidity they need, right? The Fed has been successful in more or less rescuing the system. Now, what is the incentive to get banks to lend? So with interest rate at 0%, monetary policy has run its course.
Yes.
And possibly we just need something other than monetary policy, right? And by working on the long end of the yield curve, what is that supposed to do, right? I mean, if you can't borrow at these rates and find investment opportunities, it's just that you're not looking hard enough, or as you point out, there still is something wrong with the banking system. I've looked at bank earnings this latest quarter, and bank earnings have been fine. Excuse me, I shouldn't say fine because that's perhaps too vague a statement. They've been in general positive. Bad loans have gone down. Cash has improved. Equity has improved. So, and many of the banks have said that they are looking for opportunities in middle market industries and small to mid-sized businesses. But they say they're looking for it. So, you know, I'm not too sure if the banks aren't finding it, if the banks are being over-regulated or what. But the key is that in terms of stimulus, heck, you know, if we haven't gotten it yet, what is it going to take? You know, is the Fed basically impotent here? And we do need to rely on some type of other stimulus, fiscal, what have you, state level, who knows?
Well, could it be that the Federal Reserve overreached because the fiscal maneuvering maybe was late or not coordinated? And
you know, I don't know if you can say it was late. I don't know if you could say they overreached. Do you say they brought interest rates down too quickly, or they?
well, like you were saying, maybe QE2 wasn't perhaps the best policy, and now Operation Twist maybe.
Well, you know, I'm not too sure what QE2 was intended for. Was it intended to bolster growth or promote growth, or was it intended to assist in the capital markets in supplying some type of underlying bid to a market that was still more
I
or
will
less,
say that it was about
more or less
asset
still
prices.
in some type
Yes,
of,
that's what it was.
of disarray. Yeah, I hear the mortgage-backed or the asset-backed or the secured market is still a little iffy, and so perhaps that's where the Fed is.
And that brings me, just one more comment. You mentioned the excess liquidity in the banks, excess reserves, and you said that there is enough liquidity. Could it be that the banks are accumulating those excess reserves because maybe they see the shrinking aggregate demand, and also because maybe they see that some of the assets where there's not much transparency yet, maybe they're not as good as we think they are?
I agree totally. I think that there are
In what?
projections being put into the banking systems on the availability of funds that reflect their view of where things are going. I guess overall, again, I'm coming back to the point about, though, I think we're still in the driver's seat on the global economy, and that we're going to drive ourselves well, and then everyone else will be happy.
Fall in line.
And what in fact happens when you look at the numbers, I was looking at the IMF numbers the other day. They're doing a little projection of 2009 to 2015. The global economy is going to grow from about $60 trillion to $90 trillion in that period, 50% growth. In that period, the advanced countries, those like the US and the European countries and that, are going to lose 10% of the share of that global GDP. And the emerging and the developing countries are going to be gaining 10% of that. There is growth going on in the global economy. There's some benefit, I think, to being able to get on board and say, all right, if our growth internally and our agendas are based upon falsehoods or bad expectations or lack of leadership, why aren't we looking outside at where growth is going on, latching onto that for investments, latching onto what we need to do to enable developing countries and emerging countries to grow, because that's where it's going to happen. We can't stop that. We're the passengers on the global growth
that's
engine.
already shown. The S&P 500 corporations make, between 40 and 50% of their
Yeah,
profits.
50, more 50.
Yeah.
So,
If
so
you
it's,
had
it's
exposure to
happened
those markets.
already. So whether you need the exposure or not, you have it by default by investing in S&P 500.
And you see General Electric response of putting the $3.5 billion into China when they were involved with job creation in the U.S. and put no money in the U.S. but shifted it to China. Again, it's a tough issue.
But it's kind of curious. How much of that is related to the baby boomers? How much is related to that, to a lot of these corporations with very high-paid, very intelligent consultants that have analyzed demographics, analyzed the future of the American economy, and said, well, look, yeah, the baby boomer population is retiring. They're past their peak earnings. And where is their consumption? Where is consumption growing? Art Laffer was here in Malibu maybe 2 years ago, I guess. And he said something very, very interesting. And he said, look at China. Sure, it's growing. Sure, they need infrastructure. Sure, they need this and that, whatever. And you can invest in those areas. But think about this. 400 million middle-class consumers who are new to consumption. And if you think about that, that's twice the size of the total population of the U.S. And that's just their middle class. So even though you've heard about China, will they have a soft landing? The real estate boom's going to pop. Over the long term, they are just entering, where perhaps we were in the 50s, which was the boom years for our economy, right? Where we really went into consumption, home ownership, yada, yada, yada. So, perhaps, again, the whole idea is that if you look at the shift, is the shift because of poor policy making here domestically? Is the shift here because of a bad political situation in Washington? Is it because we lost control of our lending policies and we had a housing bubble that now has put our banking system in disarray and possibly still may default or fall apart? Or is it really just some type of long-term trend where our population is aging and we just don't have the discretionary income, we just don't have the desire for consumption as we did, and the consumption is occurring in other markets.
Well, you go back to that statement, then you look at the aging population in Germany, then Germany should be in the same problems that we have.
Well,
And they're
possibly
not.
they are.
And Japan.
At least at this moment.
Well,
they're not.
Japan does,
Of course,
right?
And Japan's always had, over the last 20 years.
Yeah, but you know, you can't look at Japan and think about consumption, because Japan is notorious for not consuming,
Same thing with Germany.
and Germans, yeah, they're not.
But isn't that the
Back to
core of the
investment.
problem? I mean, we all agree that there is growth out there in the emerging markets and so on. But part of the issue of this global crisis is the major imbalance between the exporting nations, and not just emerging exporting nations, but Germany as well, and the importing nations and the advanced economies. So far the problem has been that, yes, the two issues, I suppose. One is there is growth in the emerging markets, but is that too much linked to our ability to be the consumer of last resort? And if that is the issue, how do we change that?
Couple of other pictures that come up when you start looking at some of those issues. One, we see a lot of people in buses going around the housing market in the U.S. from China. Maybe the banks are thinking, you know, we're coming into another foreclosure wave, but the Chinese are coming over and boarding the buses and buying the U.S. housing market.
Well, Don, have you heard about that latest policy
latest
out of
policy.
Washington? They'll give visas.
Resident
if-
visas.
I saw that today.
You know,
Yeah.
I mean, to me, that's a Hail Mary. That's
Yeah.
a pretty
I think-
drastic policy.
I think the other thing that we're just not recognizing in the discussion of how we should be addressing these global and issues at our own doorstep is the fact that you're going to see, at least the thought is that China, India, and others are going to go from being sort of dependent upon growth from external means, like through exporting their products and services, to focus on their own internal domestic issues. They want growth to occur. They want growth to occur internally rather than to be sending out their product and service to other people. Our numbers for the next 5 years look reasonably good in terms of increased exports in that. Unlike consumption, government spending, and investment, we have some export potential, but it's just not big enough. The other side of it, though, is if those countries start to grow on their domestic agendas, you know, can we turn our thinking to say, you know, again, we see the pattern of this. Where is it going to go? There's a fellow that was going to be a speaker that I spoke with the other day at a conference coming up in Newport Beach on global business. And they see a lot of what's going on in China now moving to Costa Rica and other countries because they're losing their competitive advantage in pricing. Their inflation is an issue, their prices are going up, their cost of doing manufacturing. They're losing out to Costa Rica and other countries now. They know that. They don't care. They don't care because their financial side of their capital accounts and their trade balances and the rest are all moving very nicely. So as their trade comes down, their capital markets are coming up. Can they get off of this gold-backed security system that they have? When will they get their currency approved? Other things like that. Those are all on the table. But the question is, you know, not to treat China as if they're the major exporter and, you know, the big consumer, but their financial markets are going to be growing. Where are they going to be growing? How are they going to grow? Where is the manufacturing going to go in the world? Those are the types of issues that leadership and corporations should be looking at, because the governments are too enthralled in their own.
And there's probably our path towards a solution, knowing that there is this huge demand popping up at some point in the next 5 to 20 years. How are we going to latch onto that growth?
Right.
We don't have the manufacturing capacity in this country. We don't even have people who can work in these jobs. They haven't been trained for the last 30 years. We don't have trade schools. We don't have apprenticeship programs. A lot of stuff that happens, and that's why Germany or Switzerland or France have the manufacturing capacity where they can export. We don't have that.
You
we have
bring
to build
up
that
They
again.
have the immigrants.
Very good point, because just recently we had to rebuild the San Francisco-Oakland Bay Bridge, and they had component steel parts. You would think in this day and age with the problems we have in employment in America that we would have Americans employed to do said same, and of course it was manufactured, shipped on barges from China. And so here's the ultimate of what you talk about, lack of trade groups be able to do the basic functions of manufacturing.
Well, I think the key to the American economy, though, has got to be innovation. And I think what's particularly damaging about the government regulation and sort of the pullback,
Stifling innovation.
is that, I mean, that's the secret. I mean, you look at the last 30 years when we started closing the steel mills and the auto plants, and we started going from a manufacturing technology to what we called a service technology. It was really manufacturing new kinds of goods and ideas. And that's been the key to our growth for the last 30 years. And right now, that's at almost a standstill. Although you do see life. I mean, information jobs in California are up. I mean, there's life across the board. But if we can't find ways to protect and encourage that activity inside of the American borders, I mean, that's what's going to pull our economy up. That's what's going to create the wealth and create the products that we can then sell to these emerging economies.
So shouldn't we shift the incentives from pure consumption and from trying to kickstart again the demand to maybe leveraging the human capital? And how do we do that?
Well, the challenge, and this goes back to the point where we've taken apart a lot of our training infrastructure, is that when we talk about investing in education in America, we're talking about sort of writing checks to the local teachers unions and preserving public employment in probably the highest cost model of education and human capital development that we can create. What we need to do instead is take that money and put it in the hands of the firms, the innovators, the companies that are doing stuff, and create partnerships between community colleges and trade colleges and places like Pepperdine where they can work together to come up with a training program that's specific to the needs of the industry and that doesn't get sucked into this, let's take our 40% for the pension system off the top and then go from there kind of a mentality. But instead, when we talk about stimulating education, it's all how do we transfer money to the state so that they can fund K-12? Or how do we hand it to the university so they can put it in the research program?
So even when we invest in human capital, it seems like it's more of a short-term solution rather than a plan.
It's a preservation of yesterday's solution as opposed to how do we invest in tomorrow.
Or a redistribution of wealth, or both together. And one of the other
Hail, labor union.
and one of the other $64 questions that overlays all this is the fact that we have a reserve currency. For how long? I mean, when you start talking about Russia and India and China getting together for another currency block, which, if in essence reduces the value of the U.S. in terms of a reserve currency, and central banks trying to get rid of the dollar as a reserve currency and only use it as a transaction balance quantity, that has a damning long-term impact on this country as we lose that advantage. And that's something we have to face up, that unless we have solid long-term growth, we're going to lose that advantage. We're going to end up not having a reserve currency.
At the moment, I mean, that weak dollar is a good policy combined with low interest rates to pay off our debt. I mean, it's the easiest way to cheapen the cost of your long-term debt.
To monetize the whole thing.
Exactly.
And be done with the whole thing, and we don't have any liabilities to pay.
So Weimar Republic, once again, in a sense.
Yes, it is.
It's scary.
But the interesting thing with the Chinese and the Indians and the Russians talking, I mean, look at Greece. I mean, Jim Steinberg, when he was at RAND, and I worked on a project right before EC 92, before the European Community kicked off. And there was this conversation, can they ever get to monetary union? And one of the things we concluded from that work was, unless you have political union, monetary union is extremely difficult. And I mean, you look at Greece, you have banks, private banks in some cases, telling the German or the Greek government what their tax rate should be and who they should tax and how. I mean, think of the sovereignty issues there. And to imagine the Chinese and the Indians and the Russians getting together and making something like that work. I mean, if the Greeks and the Europeans can't do it, it's hard to imagine. I mean, I think that in some ways the demise of the dollar is going to be a little further off. It's going to take the whole system to take the dollar.
Yes,
It could
it is
happen,
further
but
off.
it is a long way
Yeah.
off. And
Not
for a
long.
while you started to hear about oil producers in the Middle East preferring to deal with euro currency versus the dollar, right? There was a number of, perhaps you can call them belligerent governments there who wanted to deal with the euro currency versus dollars as perhaps a slap in the face to us. And where are they now? I'm sure they're sitting there saying, no more, please, dollars only, or perhaps even gold, right? The gold's run up in the last year and a half, and perhaps that's because of the problems in Europe. But I would agree that anybody who has a knowledge of public policy, perhaps has a knowledge of economics, would look at China and say, there is no way I want these people deciding what my currency is worth. And that goes as well to the Russians as well as to the Indians. So I think, you know, the position of the dollar is safe for a while, but I wouldn't rule it out that at some time there is some, you know, introduction of another currency that could take the place as a reserve
Well, then
currency.
on the subject of the currencies, I guess that, you know, we have in the next few hours the summit to end all summits, I suppose, in Europe. Can the euro really survive without what you mentioned before, without some kind of fiscal and political union? Can you have a monetary union without the backing of fiscal union?